Picture Manilal Patel, sitting behind the dusty desk of his motel in Napa Valley. It's 1970, and he's flipping the light switch on a tiny empire built almost entirely by smart, low-risk bets. But how does a modest motel owner become a billionaire investor? Hang on, because this old-school Gujarati gambler's secret could transform your approach to the stock market forever. Manilal's secret sounds simple, but it's a mental game-changer. Let's break down his winning formula that feels more like a bet at a quiet card table than Wall Street chaos. Back in 1970 Napa Valley, Manilal bought dilapidated motels. Instead of flashy renovations, he focused on steady, predictable cash flow. Minor fixes, minimal debt, and slow growth, that was his recipe. Over decades, small margins built a giant fortune. It wasn't luck, it was calculated patience. The Dhandho principle centers on heads I win, tails I don't lose much. Imagine flipping a coin where the worst outcome costs you pennies but the best nets you dollars. It's like playing poker with a stacked deck in your favor where you fold bad hands and bet big on sure winners. This mindset forces you to avoid ruin, the biggest killer of investors. Unlike gamblers chasing shiny jackpots, Dhandho investors pick safe bets with asymmetric returns. The surprise? Over time, these small wins compound quietly into Goliath-sized fortunes, leaving Wall Street's risk addicts in the dust. Pabrai urges a counterintuitive approach, fewer investments but bigger ones. Dhandho investing is less about spreading thin and more about doubling down smartly. Here's why that works. Pabrai tells the story of Papa Patel, who built wealth by betting big but infrequently. Instead of dozens of small, moderate-risk investments, he chose a few solid opportunities and went all in, like a farmer planting seeds only in fertile soil, not everywhere. The Kelly formula, borrowed from gambling, guides how much to bet based on your edge. Applied to stocks, it tells you exactly how to size positions to maximize growth without risking ruin. Think of it as your investment GPS, steering away from reckless overbets and toward calibrated aggression. By limiting bets and sizing them wisely, the Dhandho investor avoids distractions and poor opportunities. The payoff? Your capital grows exponentially, not linearly, with less anxiety and fewer sleepless nights. This disciplined bet sizing separates amateurs from pros. The last piece of Pabrai's puzzle, buying businesses nobody else wants in industries that barely change. It's counterintuitive but brilliant. Let's see why this moat strategy works wonders. Pabrai points to industries like utilities or old-school manufacturing, boring sectors that change ultra-slowly. These businesses might not dazzle but provide stable cash flows, much like a rugged ship cruising calm seas rather than chasing storms. Their predictability creates hidden value. Buying distressed companies is like shopping during a clearance sale. Prices plummet because others panic, but the Dhandho investor knows the real worth beneath the dust. By picking these fallen diamonds carefully, you get high-potential rewards with limited downside. A moat means a sustainable competitive advantage, an economic fortress around your investment. Whether it's brand strength, cost advantage, or customer loyalty, this moat protects profits long-term. The surprise? Sometimes the ugliest businesses harbor the deepest moats, quietly generating fat, resilient cash. Remember Manilal at that dusty Napa motel? His empire wasn't built overnight or by chasing shiny stocks. It was built by making low-risk bets, concentrated wagers guided by Kelly's formula, and owning businesses with unbreakable moats. So here's your move: scan for small risks with big upside and ask yourself, where's your Dhandho edge lurking? Subscribe for more book summaries like this one.